presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for March the 10th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, I want to remind all of you to click on the subscribe button so whenever I do an update, you'll be notified and you can watch it at your convenience. Let's start with the numbers. Ugly week in the markets, and it's not getting better. It seems like we've gone through some support levels and looks like we could be headed even lower. We were down 3.06% for the S&P last week, down 2.33 for the Dow, and we were down 3.43 for the NASDAQ. As you know, I like to see the NASDAQ going down the least, then the S&P, and then the Dow, but right now we had just the opposite, where the Dow went down the least and the risk assets went down the most. So that does not bode well for the market in the short term. Looking at healthcare was the best sector, financials was the worst sector, technology was in the middle. But for the year, healthcare is still up 8.6%, consumer staples up 6.4%, while the materials are up 4.4%. S&P now is down 1.7% for the year. Looking overall, oil also down as the economy is expected to slow now. We're getting GDP numbers, which could turn negative for the first quarter. That means the economy could be in a contraction in the first quarter. We're not there yet, but it looks like the numbers are adding up towards a negative GDP for the first quarter. As you know, 2 quarters of negative GDP growth is classified as a recession, and more people are talking about that as the trade war continues to heat up and as more and more allies are leaving us and moving towards looking out for themselves. So with that, it could create a lot of turmoil in the markets. As I mentioned last year, the biggest threats to the market were what would happen to tariffs and what would happen to the budget. And the budget is also something of a concern, as the new proposals are expected to blow up the deficit even further, and that we will have to borrow more money. And if we have to borrow more money, we have to issue more bonds, and the interest rate goes up. So the economy is slowing, interest rates go up, which is counterproductive, and usually interest rates go down as the economy slows, but we're seeing the opposite because we have to borrow so much money. So the two things that we talked about were the biggest threats to the economy or to the markets in 2025, tariffs and the deficits. Both are looking like at this point, now this all could go away in a few days. We don't know what the president decides. He decides, okay, I'm done with tariffs, and I've decided that I'm going to not do that to Canada and Mexico and Europe and China or whatever. I think the Chinese are not having a big impact, but the Mexico and Canada trade war is definitely having an impact. And now the president is also talking about putting tariffs in Europe. So we will see how all of this settles out. But in the meantime, it is causing a tremendous amount of anxiety in the market. And markets can deal with the negative news or the positive news, but they can't deal with uncertainty. And that's what we have. And that's when the markets get nervous. As I mentioned, interest rates went up last week from 4.24, went to 4.32, which is up for the week. Even though the stock market was down and the economy is slowing, that is counterproductive and it does not help. The biggest thing that everybody's worried about is the deficit. And this is, as you can see, this was in the early 2000s. We were nearly balanced. In 1992, then the deficit increased, came back down a little bit, and now we have exploded the deficit to an all-time high. That means we have to take more of a balance of payments, trade deficit, budget deficit. All of these are having an impact, but the trade deficit has also gotten very, very large. So is it going to help or hurt with the tariffs? We don't know. But if the economy slows, obviously we're going to import less, and that'll bring the deficit down. But at what cost? Are we willing to cause more unemployment? Are we willing to cause more problems? We'll have to wait and see. Non-farm payroll rose 151,000, a little bit less than the 170,000 that was expected. Manufacturing contracted, but it's still above 50, which shows it's growing. And ISM services rose to 53.5. That means the services is still doing well. This week we get the CPI on Wednesday, we get the PPI on Thursday, and I think that those are the two numbers we have to watch. If inflation is going up, economy is slowing, that is called stagflation, where we have a stagnant economy and inflation at the same time. I think inflation will slow down as the economy slows. Obviously, demand goes down, and that puts downward pressure on prices. But that we'll have to wait and see. How much does the economy slow? How much does unemployment go up? How much does the trade, all this trade war, how does that affect the economy? We don't know yet. Looking at the technicals, we broke below the 20-day moving average right here last month. Then we broke below the 50-day moving average right here. And today we're sharply below the 200-day moving average. That's this line right here, the magenta line right here. We broke below it to the downside. Next support is right around here, which is 5,400. That is the September low. And then the August low of about 51.25 or so, right around here. Those are the two support levels now left in the market. Looking at the weekly charts, again, we've supported the 20-week moving average since October of 2023. We broke below it 2 weeks ago. That was not a good sign. And now we're below it again, the 50-day moving average. I thought the 5650 support would hold, but we are at 5570 today, about half an hour before the close. So next support now is right around the 50, a little bit here at 5400, and then more support here at 5125 or so, and then right here just around the 5,000 area. So we have come down about 700 points now, which is somewhere around 10, 11% down. Looks like we are in a correction mode now for the S&P. So we'll have to wait and see how this trade war figures out, and that's having an impact. Looking at the NASDAQ daily, we went through the 200-day moving average last week. Today we're sharply lower, down about nearly 5% for the NASDAQ. Next support is right here around just below 17,000, and then the August low of about 15,700 or so. So those are the two support areas that we see now, right around here and around right about here or so is where we see the support levels. So those are the two support levels now we have in the market. We've started a wave count to the downside, wave 1, wave 2, wave 3. We're going to get a wave 4 bounce somewhere here, and then a wave 5 to the downside. That's the way the markets are setting up. Looking at the weeklies, again, the 50-week moving average was holding last week. We came down, bounced above it. But as I mentioned a couple of weeks ago, when the dots turn negative, when the market is below these dots, like it was here, usually when it turns down, it's down for 6, 7, 8 weeks at least, like we saw here. This was the October low that we saw, and this is what we saw last year in October, August, September. Now we've turned negative also. So how far down? We have support right here, and then around, as I mentioned, around the 15.7 area. Those are the two support areas that we have in the market. Interest rates sharply, we bounced up from the 4.1 area. We're at 4.21 today, but I still looks like wave 1 to the downside, 2 up, 3 down. This looks like wave 4 to the upside, and then we'll see wave 5 to the downside. As the economy slows, I think we're going to continue to see downward pressure on interest rates. Small caps breaking below the 200-week moving average, not a good sign overall. 1, 2, 3, and then we could get a fourth wave bounce somewhere, and then another fifth wave decline to the downside. Crude oil, as the economy slows, demand for oil goes down. We're hovering right around the 65 area this morning, and the low is right around here, 65 and change. That's the 64 and change. That's what we saw the low last September. We're getting very close to that low around this area right here. But that would be, again, wave 1, 2, 3, 4 up, and then we'll get the fifth wave to the downside. So everything looks pretty bearish, but we are extremely oversold in the markets. We could be in for a bounce. We'll have to see where the bounce takes us. That'll tell us if the correction is over or not, or are we going into a bear market. If the economy goes into a recession, obviously companies can't sell as much. They can't sell as much. They can't make as much money. The profits go down. Consequently, the market has got to adjust to that. I don't think the administration wants a recession, but the president said yesterday that he could see a recession in the economy, and it's short-term pain for long-term gain. We'll have to wait and see how much pain can the electorate take at this point. We'll have to wait and see. Gold breaking below the 20-day moving average. Support is around 2,800. We're 2,887 this morning, and below 2,800 is the 2,600 area. So we'll have to, I think gold will hold around 2,800 if it gets down there at all. Those are my thoughts. Those are my views for this week. Again, making sure, as we've talked about for the last couple of weeks, having that balanced portfolio is really the key. Even though the markets are down 2% or more, if your portfolio is down 1% or half of that, that's part of what we're going through. But again, you did not gain as much because you had a balanced portfolio in the markets, but you're not losing as much. And the trick is, it's not what you make, it's what you keep that counts. Having that go-go portfolio is going to be go-go gone. So again, you make money very quickly, you lose it quickly, you're on this treadmill, end up going nowhere. Having the right balance, having the right mix in your portfolio is the key. If you're feeling uncomfortable, give us a call. We'll be more than happy to help. Call us at 800-388-9700 or send us an email at invest@compact.com. Invest@compact.com. We'll be more than happy to give you a call back, look at what you're trying to accomplish, make sure you have the right allocations in your portfolios, and set you up on that long-term path for success. Again, don't forget to subscribe to this channel. Click on the subscribe channel so whenever I do an update, you'll be notified. Those are my thoughts. Those are my views today. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.